Hello, everybody. We are tackling partnerships, and I realized when I was about to prep for this video that partnerships is a super long chapter, and it's too long to fit into one video and kind of too much to put into 1 week where, I mean, you guys, again, we're not in a classroom setting. Even in a classroom setting, it'd be too much. So I'm splitting the partnership chapter up into two parts. The first part is just what happens when a partner starts a partnership and they join, and then what happens with a partnership that has income. Okay. The next week, we're going to make partnerships. We're going to make what happens when a new partner joins the partnership. Okay. There's some calculations we have to do, stuff like that. Okay. But to get started, briefly, read through the PowerPoint in the book for specifics on characteristics of partnerships. But generally, it's a form of business with two or more owners who are called partners. They operate and run a business, whatever they want to do for their business. Um, and they generally create what's called a partnership agreement, which outlines how the partnership is going to run, how income and losses are distributed and shared amongst the partners, stuff like that. Uh, I'm sorry, I don't have my computer plugged in, so I'm checking the battery. With partnerships, there's also what's called unlimited liability. So any debt the partnership takes on or any lawsuit against it, the individual partners are liable for that debt. So if the partnership itself, the business, can't pay the debt, creditors could come after the partners and their personal assets. So they could come after a partner's house and put a lien on it to get their money. Okay, they could come after their smaller assets and repossess them. So with partnerships, they have that liability. But read more about the actual characteristics. I'm going to focus on the journaling and physical stuff that you got to see to learn. And to start, we're just going to start with a new partner joins a partnership. So we're going to pretend a partner is just joining a brand new partnership. And this partner is contributing $34,000 of cash, $15,000 of inventory, equipment worth $29,000, liabilities totaling $12,000 in the form of note payable. So when a partner joins a partnership, they can contribute whatever they want to the partnership. They can contribute any assets, they can contribute any liabilities. Okay? And what happens is the partnership just takes it on as its own. So you have to keep this in mind. The partner, the individual, is giving this stuff to a partnership, a business. Okay. And remember, when we make journal entries, we have the mindset of the business, not the individual. So we are not the partner. We are the partnership, the business. So we, as a business, are receiving 34,000 of cash, 15,000 of inventory, equipment worth 29,000, and liabilities totaling $12,000. Okay. So yeah, a business can assume debt. It could assume liability. So what happens, this is, don't overthink this. This is pretty straightforward. From the partnership's perspective, again, the business perspective, when it comes to taking these assets and liabilities, you just have to recognize a journal entry that recognizes that cash is being gained. So we debit cash. So all assets that are contributed to the partnership would be debited. Okay, so cash is an asset. Debit, inventory is an asset, 15,000. Equipment's an asset, 29,000. Okay, what happens when you're a business and you incur a liability? Okay, you incur debt. Well, when you're a business and you incur debt, you credit it. So in this case, when we're a business and we are receiving, we're taking over some debt, we're going to credit notes payable. We're going to credit that liability, 12,000. Okay? So this, it doesn't get trickier than this for right now. Um, so for right now, whenever you're a business, whenever you're a partnership and a partner's coming in and they're giving all this stuff, you just debit the assets, credit the liabilities. Okay? We know that when assets are increasing, you debit them. When liabilities are increasing, you credit them. So it's the same concept. But now you're saying, hey, the debits don't equal the credits. The difference when the partner contributes assets and liabilities, or even when the partner just contributes assets, the difference to make the journal balance is a credit to the partner capital. Okay? Let me move that over. So, in this case, our total debits, they equal 78,000. See it down here, 78,000. So we have 78,000 of debits, only 12,000 of credits. So the difference of 66,000 is going to go to partner capital. Okay? So this is owner's capital, partner capital, owner capital. Okay? If we had a specific name here, if we said John joins a partnership, it would be John Capital. All right? So this is that owner's capital figure that we have dealt with in the past. You've seen in Principles 1. Okay? It's just a partnership perspective. So assets are debited, liabilities credited, the difference goes to capital. Okay? So, partnership income. So again, partners have to have 2 or more owners. Okay? In this case, I'm going to deal with Bruce and Tim. They have a partnership. And we're going to say this is the most basic form of partnership income. The partnership earned $200,000 in income for 2019. Partnership income. Partners in the partnership at any time throughout the year could distribute money to the owners. Okay? When it comes to the income, just because a partnership had a net income, again, revenues minus expenses. So at the end of the year, this partnership had $200,000 of net income. Just because they have that net income doesn't mean they give it out in cash to the partners. Okay? It's just, hey, here's net income. This is what we have, $200,000 in income. What do we do with it? Okay? It has to be distributed to the partners. Yes, 100%. And what it actually does is it goes to the partnership capital. Okay? So, in that partnership agreement I talked about on the first page, what happens is partners agree right in that agreement. It's not mandatory, it's really recommended though to have a partnership agreement because it avoids any liabilities. And in the partnership agreement, you outline, hey, Bruce is going to receive 10% of net income, Tim will receive 90% of income. That's all up to them. There's no law that says one partner only gets 10%, one gets 90. It's up to them to decide what do they want to do. Okay? If the partnership agreement doesn't say anything, it is split 50-50. And I'm going to pause for 2 seconds. Okay, we're back. Hopefully that picks up nicely. Sorry, I had to take a quick break. Anyways, so partnerships earn $200,000 in income. The income is just distributed at the end of the year after closing entries are made. If we do a quick revisit to Principles 1 and closing entries, you would remember, let's say for this partnership, they had revenues, we're going to be real easy, of 800,000, and they had expenses of 600,000. Okay? So at the end of the year, what a partnership has to do is they have to close out their revenues and close out their expenses. So revenues would get closed by debiting the revenue account, 800,000, because revenues have credit balances. So to get rid of a credit balance, you got to debit it. And we would credit income summary. That's a temporary account that is only used for closing entries. Okay, do you remember that account? Income summary. It's a temporary account. It doesn't belong to any specific account type. It's used to eliminate other accounts. Okay, it's kind of like an assassin of accounts. Expenses would get closed out. Expenses have a debit balance, so to get rid of expenses, you would have to credit expenses. So to offset them with a debit, you would have to debit income summary. So we would debit income summary, credit expenses. And now what would be left in the income summary if we had a T-chart, I just want to show you what this looks like. Okay, again, this isn't closing entries chapter, it's partnership. So this is just going to be a super rough reminder of how closing entries work. Income summary would have been credited for 800,000, and then we just debited it for 600,000. And then the difference is 200,000. So that's where this net income comes from. So when income summary has a credit balance, it's net income. If income summary had a debit balance, it would be a net loss. Okay, because that means expenses are greater than revenues. Okay, just something to keep in mind. So, anyways, when we're going to do this, get rid of the closing entries. When we distribute the capital to the owners, get rid of this. It's going to come out of income summary. So in this case, we don't say anything about how income is distributed. We don't say 30%, 70%. We don't give percentages. So if nothing is given, assume income is split 50-50. Okay, 50%, 50%. So that means of this $200,000, 50% is going to be credited to Bruce Capital, and then 50% is going to be credited to Tim Capital. Okay, $100,000. The debit goes to income summary. So remember that T-chart, income summary had a $200,000 credit. Now it needs to be debited 200,000 to eliminate it. So partnership income, if it doesn't give you a percentage of like Bruce gets 10%, someone else gets 90%, you just split it evenly amongst them. And it doesn't get sent out as cash. Okay, so that's important to know. When there's partnership income or loss, it is just distributed to their capital. So Bruce's capital is increasing $100,000 because of the income. Tim's capital is increasing $100,000 because of the income. Okay, and it comes from income summary. So after closing entries are made is when you distribute the remaining income. Okay, so this was a basic example. Sometimes partnerships in their partnership agreement have service income agreements. And what this is a partnership will actually pay income to the owners. If the owners do work in the partnership, they'll take an income. Well, this income comes out of the total profits the partnership made. So let's look here. Bruce and Tim agree in their partnership agreement that Bruce would receive $5,000 a month as service income, and Tim would receive $7,500 a month as service income. The remaining net income will be split evenly, and they made $200,000 total. So their net income, just like the last problem, is $200,000 total. So when distributing net income, first allocate any service income. Okay? So what this means is look at what they're supposed to receive. Okay? This could be worded any way it wants. In this case, it's worded Bruce would receive $5,000 a month. Tim would receive $7,500 a month. So for the whole year, you have to put it into the year since it's in a month. Bruce would receive $5,000 times 12, which would be 60,000 as service income. Tim would receive 7,500 times 12, or 90,000 as service income. All right. So this also service income goes towards capital and is distributed out of net income. Okay, that's important. So Bruce is receiving 60,000, Tim's receiving 90. It comes out of their total net income. So right now, net income is $200,000. minus Bruce's $60,000 that he's going to receive, minus Tim's $90,000, and we're going to be left with remaining, or I'll put leftovers, 200,000 minus 60 minus 190. So the remaining net income is 50,000. The problem says the remaining net income will be split evenly. Now again, it could say the remaining net income will be split 10% to 90%, 40% to 60%. In this case, it says the remaining net income will be split evenly. So that means this remaining 50,000, after each gets their share of, their share of service income, the remaining is split evenly. So now 25,000 will go to Bruce, 25,000 will go to Tim. So I'm actually going to make a chart. Service income. So that's what each is getting out of service income. And then share of net income. So this column will be the remaining net income. What are they going to receive? So Bruce will receive 25,000 and Tim will receive 25,000. So I'm going to move this down here. Total share, or I don't want to worry like that, total distribution of net income is going to be their service income. Their service income plus their share of net income. So it's going to equal this plus this. So Bruce will receive 85,000. Tim will receive 115,000 in this case. And the journal entry that you do this is the same process. You debit income summary for that full $200,000 amount. Okay, because again, this is coming out after closing entries, it's coming out of net income. And then we're going to credit Bruce Capital for 85,000. And we're going to credit Tim Capital for 115,000. And that's it. So with service income, that's it. You just want to make sure that your total credits equal your total debit, which it does, sum 200,000. Okay, and I think making a chart's nice, and you're going to see why, because we're going to take this a step up now in the next tab. We're going to look at partnership income with a percentage of capital given out. So this is another thing that could be in the partnership agreement. In this case, $200,000 of net income Bruce and Tim earn. Each is going to receive 5% of their invested capital as of January 1st as additional shares of income. So in a partnership agreement, they could say, based on whatever your capital balance was in the beginning of the year, you will receive this percentage as an extra share of net income. So in this case, it says each partner will receive 5% of their capital balance. That's what this means. Their capital balance from January 1st as an additional share of income. Okay? Then it says Bruce had invested capital of 100,000 and Tim had invested capital of 60,000. So real quick, I'm going to make 2 charts for each of them. So what this means is Bruce had a capital balance of 100,000. Tim, hold on, let me make this beautiful. Tim had a capital balance of 60. And remember, capital has a credit balance when it's positive. Okay? So at the beginning of the year, prior to this net income happening, this is what their capital balances was. Okay? And it's saying each will receive 5% of their respective capital balances as an additional share of income. Okay? Now, keep reading. It says they will still receive the same monthly salary. So that means they're still going to receive, Bruce will receive the $5,000 a month service income. That's his monthly salary. Tim will still receive the $7,500 a month as service income. So they are both still receiving that, and then the remainder of the net income is split evenly. So the percentage of capital comes out of net income, and the monthly salary comes out of net income. Okay. So I'm going to make another chart. I'm going to make Bruce. I'm going to make Tim. I'm going to make a category for percent of invested capital. I'm going to make a category for service income. And then I'm going to make a category for share of remaining net income. A column, I should say. Okay. You don't have to do it like this, but I think it helps. Okay, to make things look neat. And then total, I'll put allocation. So of the net income, what's their total allocation they're going to receive? Okay. So percent of invested capital. Again, this 5% could be any number in the world. They chose 5% of their beginning capital. So Bruce is going to receive 5% of his beginning capital of 100,000. So 5,000. Tim is going to receive 5% of his beginning capital of 60,000. So 3,000. Next, fill out their service income. It's the same as the last page. Bruce is going to receive 5,000 for 12 months, so 60,000. Tim is going to receive 12 months of $7,500, so the 90,000. Okay. So now, before we can do the share of remaining net income, we have to see what is left for net income. So if I make a total column down here, total invested capital is 8,000. Total service income is 150,000. And what we would do is we would take the net income, 200,000, and we would subtract, let me put it like this, the total 8,000 right there, and we would subtract the total 150,000 for their service agreement. Oh, sure, you had to work nicely, but the other one didn't. So we're left with 200,000 minus the 8,000 minus the 150,000, or $42,000. So this is the remaining net income. And the problem says they're going to split it evenly. Again, it could say they're going to split it 30-70, 60-40, whatever they want to do. But they say it's going to split evenly. So then 42,000 divided by 2 is going to be 21,000 each that they're going to get. That's from the remainder of net income. So again, the share of remaining net income comes last, after you calculate their share of invested capital that they're going to receive, and then their service income. Okay, I'll just total this down here, just so you can see it does equal to 42,000. So now total, Bruce is going to receive, oh, come on. Bruce is going to receive the sum of his invested capital share, his service income, and then the remaining net income. So he'll receive 86,000. Tim, same formula. He's going to receive, big surprise, 114,000. Okay. So we're going to go ahead and journalize this the same way we have been. We're going to debit, I'll do it here, debit income summary for the full $200,000 of net income. And we're going to credit Bruce Capital. I'll put Bruce Cap for 86,000. And we're going to credit Tim Cap for 114,000. Okay, so that's the journal entry. It's just a new way to figure out this value because of what's going on up here. So now if we were to just go and update their T-charts, Bruce's capital would increase by 86,000 and Timmy's capital would increase by 114,000. So now their new balances would be 186,000 for Bruce and 174,000 for Tim. Okay? So this is how partnership income is distributed. It goes towards their capital. And then at any time during the year, Bruce or Tim could withdraw money from the partnership if they want. But the net income, I can't stress this enough, net income is not actually given to the partnership, to the partners as cash. It's only given into their capital account. Okay? So it is not automatically distributed as cash. Okay? So we saw these three. Again, really, they just built on each other, starting off with just net income. If nothing's in the partnership agreement about how to split it, it's split evenly. Then we saw service income. It's basically a, a salary that comes at the end of the year to increase their capital. Again, it's distributed at a net income. So you start with the salary first, the service income, then you split whatever's remaining, unless the partnership says do something differently. And then if you have a scenario, again, these are all if scenarios. Partnerships are not forced to have salaries nor to give a capital percentage distribution. Okay, so these are all if scenarios. If you have an agreement where a percentage of your capital is to be distributed, you do that first, you do the service income, and then lastly, you split the share of remaining net income. The last thing we're going to look at is what happens if at the end of splitting up, giving their 5% of their capital, giving their salary, what happens if the remaining net income is a loss? So if we look on this sheet, it's the same as this sheet. I'll even copy over these T-charts quick. I'll move them over, put them here. Okay. So Bruce and Tim had the same beginning capital. Okay. 100,000, 60,000. They're each going to receive 5% of their invested capital of January 1st. So again, same thing. They still receive the same monthly salary they have been receiving. So 5,000 for Bruce, 7,500 for Tim. But we're going to say they only have 150,000 total in net income. Okay. So their net income is no longer 200,000, it's now 150,000. All right. So again, let's make the chart. I'm going to be lazy because this is a video and it's not like I have to rewrite this for you guys to re-see it. So change this quick. Bruce is receiving that. Tim's receiving that. So everything starts the same. Okay. Bruce is still receiving his 5% of his initial capital. Tim's only receiving his 5% of his initial capital. They're each receiving their total salaries, their service income. Okay. And now the remainder of net income share. Okay. I've worded this like 5 different ways. So first, before we could split up the remaining net income, we have to see what is left. Okay. And if we do this, so remember, we changed on this specific tab. Net income is $150,000. All right. We're going to subtract the total invested capital share. So we're going to subtract the 8,000, and we're going to subtract the 150,000, the total salary share, service income salary. So what we're left with, the remainder, big surprise, I can't spell. I did it up here too, remained. This is what happens when you don't have social interaction for a year straight. Remainder is going to be 150,000 negative $8,000. So they're based on their partnership agreement, their percentage of invested capital and their service income is more than what net income has available to give them. So what actually happens when you have a negative amount after you allocate a share of net income to both of these categories, it's still split, and all it does is it reduces both of these columns. So their remaining share of net income would now be a negative amount. So they're going to receive, or they're going to reduce their share of net income by $4,000. So when we go ahead and we do the total share column, it's going to be this $5,000 plus their service income plus their share of net income. But this is going to actually bring it down, because what we're doing is we're saying 5,000 plus 60,000 for Bruce minus $4,000. So instead of receiving the big amount he got here, it's actually going to go down. 65,000 he was going to receive based on his share of invested capital and service income, but because based on their agreements they're distributing too much money, he's actually going to have to take less than what he should be getting because the partnership didn't earn enough income. So Tim is going to receive $3,000 plus $90,000, so $93,000, but he's not allowed to get all of that because there's not enough income for it. So this $93,000 right there minus the $4,000, Tim's only going to be left with $89,000. Okay. So again, this is just a scenario when the partnership income, when they distribute based on their salaries and their share of income, share of invested capital, sorry, if it causes a negative number to be the remainder of net income, it has to reduce what they're going to get back. So now our journal entry, that's not going to change. We're going to debit income summary, the full, now it's 150,000 because remember we changed it up here, and we're going to credit Bruce capital 61,000, and we're going to credit Tim capital the 89,000. Okay. And then we would update their charts. Bruce is going to get 61,000. So now his new balance is 161. Tim's going to get 89,000. So his new balance is 149,000. Okay. So this, as you can see, it's a lot to take in. In class, we would have done multiple examples where you could ask me questions so I could answer the specifics. At least with the video, you could rewatch it for all the specifics. Ask me questions, though, on these specific items. Okay, a brief summary. When a partner joins a new partnership and they contribute assets and liabilities, again, you're the partnership perspective. You debit assets you're receiving, credit liabilities. The difference is credited to capital. Partnership income, you go by what the partnership agreement says first. If the partnership agreement doesn't say anything specific, you just split income or losses evenly. If there's service income, so basically a salary, at the end of the year, Bruce would receive a $60,000 salary based on $5,000 a month. Tim would receive a $90,000 salary based on $7,500 a month. We're talking about salaries that come out of net income, based on net income. You do that first. the remainder of net income, 50,000, unless it's said specifically in the partnership agreement that net income, the remainder is split a specific way, you just split it 50-50. If there's a percentage share of capital, you do that first, okay? You do the service income, and then you split any remaining net income. If it's positive, you split it and give a positive number. If it's negative, it unfortunately reduces their share of their capital, and then the totals you credit to the specific partner accounts, and it comes out of income summary. Again, income summary is a temporary account used only for closing entries, and it's not a specific asset liability. It's nothing like that, okay? So that's where I'm going to end this video. I'll put up practice like I always do, and then I'll give an assignment and tackle it from there, okay? Over and out.